Welcome to the Techno Fundamental Report for March the 6th. To dare is to lose one's footing momentarily. Not to dare is to lose oneself. Soren Kierkegaard, a Dutch philosopher. So you gotta take chances in life. I have found that you got to take a chance every once in a while and venture, because if you don't, you're never really going to make any progress. Now, I wanted to mention the concept of contextual thinking or contextual learning. Very important. You know, when we look at these indicators, there's no panacea. There's no absolute answers. So you have to kind of look at the indicators and say, okay, contextually, this makes sense. So you have to look at multiple indicators just to get into your brain what you think is really going on. Now, we just wrapped up earnings season, and this is a book that I would recommend highly called Trading in the Cockpit with O'Neill Disciples. And it's the uncertainty of company earnings announcements. Very difficult. This is a very difficult part of the process. But if you handle earnings season correctly, you can really deal with the issue without much problem. But it's still an issue. And most investors need to understand first that there is no foolproof method of avoiding a potential gap down in a stock one owns following its earnings announcement, should that earnings announcement be perceived as negative by the market. So there's really no panacea here. What you have to really get into, and by the way, you may want to pause your video player and look at this particular subject, but we'll save time and just kind of skim through it, and you can read it if you would like. So the answer to the question is basically risk management. And the first thing I would say when I'm dealing with earnings season, I know earnings season is coming. Then I'll go look up the dates of my companies to see what date they announce their earnings on. Now, the last thing I'm going to do is I'm going to buy on top of an earnings announcement. I rarely do that. I would recommend that you just kind of be aware of the date and see how things work out. Now, if you do take a position in the stock going into earnings season, first of all, if you have a stock that you have a big profit in, or what we would call a profit cushion in the stock, you can tolerate gap downs a lot easier. But what's also important is to manage the portfolio from a percentage of ownership of positions. So like it says here, it says, thus one need only determine if one has a 10% position in a stock that gaps down 10% after a bad earnings announcement, it will cause a total of 1% damage to the overall portfolio. The 1% rule is a good rule because we've always found that if we do get hit by 1%, we have 99% of the portfolio to go get our 1% back, and we usually do. Now, you can also go to a 5% position. So if you have a 5 to a 10% hit on a 5% position, you're only looking at 1/2 of 1% damage. So when you're going into earnings season, be aware of these points. First of all, be aware of the date and be aware of the size of your position going into the report. Because if it comes in bad, it could really damage your portfolio. Whereas if you have like 50% of your portfolio in one stock and it drops 10%, well, that's 5%. That's hard to get over. Investors complicate the investing process by wasting time and energy trying to find ways to eliminate uncertainty. And we already know that that is an impossible proposition. So you're never going to be able to have absolute certainty. That's just a fact of life with the stock market. The primary trend continues to be up. We're starting to see a pullback here in the S&P. We actually broke the 200-day on the NASDAQ. So this market is definitely under pressure. The only good news that I could really mention here is that sentiment, meaning the bull-bear ratio, where there's a survey done by AAII every week. And the most recent week, the bears far outnumbered the bulls. So we're starting to see that capitulation hopefully taking place. So hopefully we're putting a bottom in here, and we'll talk more about that as we go through the report. But remember the concept of contextual learning, because these indicators that I'm going to discuss, you take them as kind of a secondary thought. The primary thought has to be the overall trend of the market. Now, interest rates, as we know, because of all the worries about a growth scare, we're seeing interest rates coming down. Now, this is the 10-year Treasury note that's currently yielding 4.2%. The power index is still above zero, so we're just not out of the woods yet with interest rates, but they are starting to come down. Also coming down is the price of oil. You can see here oil is, here above 68. Now, as of today, we're down around 66, 67 a barrel. The trend is down in oil, and one of the concerns here is with, drill baby drill. The problem is that if oil gets under $60 a barrel, it makes it very difficult for these shale companies to make any money. So it's just something to be aware of. The aggression index, we're seeing definite action in the aggression index. Remember now what we're doing here is we're measuring the NASDAQ compared to the consumer staples. So technology compared to toilet paper. Now, the reason this is important, and we've discussed this in the past, is large mutual funds, large portfolio managers cannot go to cash. It's just not feasible. Therefore, when they get worried and they're worried about the economy, they start reconfiguring their portfolio into toilet paper and getting out of technology. So you can see here back in the bear market of 2022, we got a definite sell signal on the aggression index. Well, we're getting it here. So just be aware of the fact that, the technology stocks are starting to suffer compared to the consumer staples, which is just not a good sign. Another bad sign here is we're getting way too many lows on the New York Stock Exchange. We recently got 289 new lows, which is the highest reading of new lows in quite a while. So that's troubling as well. Also, the semiconductors. This is an ETF of semiconductors. We're seeing kind of a major breakdown here. Now, we may get a rally, and we're going to talk about that here in a second, but the semiconductors are definitely having a problem here. Now, one of the other indicators that we can look at is something called the trend lines. Now, I've got dots on here to represent weeks. I have a 35-week moving average, and the rule is very simple. We simply say that if you break below the 35-week moving average for 2 consecutive weeks, that is very bearish, and if you look back at the last time that happened was in the bear market of 2022. So I'm not predicting a bear market here. I'm just simply saying we're starting to see some troubling issues out there, which means you just need to really be paying attention to your portfolio right now. I would hold off on heavy buying, and I would also, if you have stocks in your portfolio that are just not acting properly, might be a time to do a little house cleaning. Here's the S&P 500. Now, we have broken that moving average for the first week. So remember, it's 2 weeks, and it has to be both the S&P and the NASDAQ to get the sell signal. Now, let's look at some indexes. Now, I want to mention something here that's done by the Investment Business Daily, IBD, research team. They have come up with something called the follow-through day. Now, not every follow-through day is going to work. Again, being contextual, we have to take it in context with everything else we're looking at. So we already know that the aggression index is in trouble. We already know that the trends are down, and we're possibly struggling with a breakdown in the trend line. So be aware of the fact that, the follow-through day is not a panacea. It's just another statistical indicator that can help us make the right decisions. Now, here's the low from last Friday. And so the purpose of the follow-through day is to keep you from jumping in too quickly. So you can see here we got this drop, and Friday we made this low. And, everyone, including myself, felt like that we had made the low. But then on the following Monday, we broke to a fresher low. So your start of the follow-through day is very simple. You start at the low, and then if we get a rally that can last 3 to 4 days, which would be, so this low would have been on Tuesday. So we need to go 1, 2, 3, 4 days, which would be next Monday. The purpose of this is just to slow you down a little bit, because we all know with bear markets, now every correction I've been involved with, some of the time those corrections turn into bear markets, which can be, quite dramatic declines. I'm talking 40, 50% declines. Now, if this is just a correction and we've made the low, great. However, I thought the low was here, and then boom, this is the low now. So we would start the count as of today. And so we've had 1 day above the low. Now, if this particular drop, if it turns around and drops down below that low, all bets are off. You have to start the count over. So what happens here is you get the low, you go 3 to 4 days. If you get a nice rally of, let's say, around 2%, and the volume is high and higher than the prior day, that can be a follow-through day. So you could start to nibble a little bit. But right now, I would wait for that follow-through day. Small caps are really having a tough time here. They've broken the 200-day moving average, definitely in a downtrend. This is risk off. In other words, the small caps tend to be risk on, risk off. This is risk off. It's in a downtrend, just to be aware. S&P 500, now again, the follow-through day could be, now on the follow-through day, you either use the NASDAQ or the S&P. So we made our low here, and then we've rallied. So hopefully we continue to hold this low right at that 200-day moving average. So we'll talk next week about the follow-through day, because we'll know more then. So if you have any questions, don't hesitate to ask. Thank you very much.